Two Australians buy their first property in the same year, same budget, same city. 20 years later, one ends up with a paid off home, the other ends up with four properties and never worked a day past 50. Same start, completely different life. Today, my guest explains the difference. Today, we have Australia's leading buyer agent, Allan, with us, who will unpack the property buying journey for you. Welcome to Big Decisions, Allan.
Pleasure to be on, Karan.
Thanks for coming today. So, starting with when I think about buying a property, the go-to person that comes in my mind is a real estate person. So, and for me, buyer's agent is relatively a newer term. So, what do you like? Can you explain people who is a buyer agent in simple terms, and how are you different from a real estate agent?
For sure, yeah, great question, and that's what a lot of people think of. You know, when they think of real estate, a lot of people know what a sales agent is, a buyer's agent. The buyer's agent industry is still relatively new and growing. But yeah, I guess to understand what a buyer's agent is, we got to understand what a sales agent is. So, you know, a sales agent, or your standard, you know, what people think of when they say real estate agent, is someone who advocates for the seller. They got their seller's best interests at heart. And their job is to just get the best outcome for the seller, whether that means getting the absolute best price possible or getting an extremely quick sale, might be a lower price, and just getting the best outcome possible for the seller. In doing so, you know, they don't really care too much about the other side. They don't get paid to get the best outcomes for the other side, which is the buying side. So a buyer's agent is the exact opposite. You know, they care about the outcomes, or they should care about the outcomes for the buyer and getting the best outcome possible for their buyer, whether that means there's different types of buyer's agents. You know, there's buyer's agents who help clients buy their dream home. So it's, you know, finding that ideal forever family home.
Right.
Or it could be buyer's agents that help with investment properties, whether that's getting good cash flow properties or maximizing capital growth, but just getting the best outcome possible for the buyer.
So I think the name depicts itself. Buyer agents are experts who buy property for buyers, like keeping their interest in mind. However, real estate agents are the people who are focused on the seller side. And let's say if I go to a real estate agent to purchase a property, I think real estate agent will be more inclined towards the seller side because he's getting commission from the seller for sure. And for me, in order to get the best deal, I think I need an expert like you on my side. I think it completely makes sense. And when we think about, real estate agents, and if something goes wrong with them, there are bodies, they are regulated in that way. What about buyer agents? Are they regulated as well? Or is there anyone sitting on top that if anything goes wrong, they have someone to talk to?
Yeah, definitely be exactly the same because buyer's agents are still technically real estate agents or estate agents, right? So exactly the same. It'll be state-based. So, you know, every state has its own kind of governing body and its own licensing agreements to become to become an estate agent.
So I think now as you're talking about real estate agents, when someone is selling a property, definitely they're getting a percentage commission on the sale, and roughly it comes around 10 to 15K. That's depending on the price of the property. Yeah. Now I think for having you on our side, what is the estimated cost of a buyer's agent like in the market?
So average in the market I'm seeing these days can range probably from like $12,000 to $20,000. Then you do have some outliers like maybe some junior BAs or people just getting into the industry charging 10K and under. And then you got your outliers on the other end who charge like a minimum of $35,000 and above. Me at the moment, I'm at that 14, 15K mark, depending on the fee structure and purchase price. Like for lower price purchases, I even go down to 12 or 13K as well.
Right, makes sense. I feel like, when I hear about 15K, because I've never bought a property, even that figure looks a little big to me, but I feel like definitely that the outcome that you give out of that 15K will definitely, overcome that amount. So now when we talk about, as we're talking about the cost, is there any minimum purchase price on which a buyer agent actually makes sense? Like, is there any time like some customer has came to you, they're like, they want to engage your services, but you have told them no, because it won't make sense for them to pay this much amount of money, and the ultimate capital growth or the ultimate benefit they'll get from the property will not make sense?
The only time I've said no is if it goes against my fundamentals. Like I think this year I said no to someone because they had a budget of about like $320,000 and they wanted to get a freestanding house.
Okay.
Where, some other operators might take them on board and buy in a tiny regional town in the middle of nowhere. So that's the only time I say no. But as long as people have realistic expectations and their price point, we can still get really good results based on my frameworks, then we take them on. In today's market, it's generally like a minimum of like $350K around that mark.
350K. So you mean to say, like, if someone wants to buy something around 350K and they are happy to go on your advice, you are like that 15K or the buyer agent fee will be justified. The overall capital growth will definitely be more, because what the reason I asked this question was because there are many people who are still looking, who are entry level in this market, and they're looking at around 300K, 350K. But even let's say the Australian average that I researched was around 6% capital growth, 6-7%. I may be wrong. You are the right person to answer that.
Yep.
So, but I feel like when I do those calculations, I feel like the numbers don't match. Like, it will take a lot of time to at least cover the buyer's agent fee itself. So what do you want to say on that?
The long-term average, you could say, is around like 6.4%. That's like based on data over 40 years, right? And during that time frame, you're going to have periods of overperformance and underperformance. So if you time the market well and you get into the right asset, you're generally going to see a lot more than that in the initial 3 to 5 years and beyond. Like when I was buying in the early days in, let's say, regional Queensland, Perth, regional WA, a lot of those clients within like 2 years were sitting on above 60-70% plus capital growth.
Oh, that's
Now, I don't think you're going to see the same thing in today's market.
Okay.
But you will probably see above average capital growth getting into the right markets in today's market. But another important thing to consider is not just how much money you can make, but how much mistakes can you avoid? Because a lot of people just look at, okay, I'm only going to work with a buyer's agent if they can save me $15,000 in a purchase price. But that's not really where the value lies. It's also about stopping people from making a $150,000 mistake.
So it's not just about making money in the market, it's also about saving from losing money when you purchase a property. As you're talking about it, is there any example you can give in like on which people made mistakes without, if they didn't know about how to purchase a property and they didn't even hire an expert like you, what sort of like money they lost during this process?
Good question. Put me on the spot here. But I guess a common mistake I can see in today's market is because, let's say in the early days when I started the business, we could be snapping up freestanding houses in really solid locations with long-term fundamentals in the 300,000s. You can't get houses at that price point anymore. So a common mistake I'm seeing is people think, I need to buy a house. Only houses grow. Let me go buy a house, and you go buy in the middle of nowhere, and you can't sell it for any more than what you bought it for, even 5 years later.
All right. Makes sense. Today, that is actually how to buy a property using like what are the secrets you use when you're looking to buy the property and avoid all the mistakes. Let's talk about the Australian property market in general. What does it look like right now, and what are we in the cycle post-budget?
The Australian market to me looks exactly like how it's always looked, where there are specific markets, price points, and types of assets that there is excellent opportunity. And there's also many markets and assets that are a terrible opportunity right now.
Okay. Cool. So it's, I think in terms of buying, the situation kind of comes at the same level. It stays the same. And like if done the right way, whatever situation we are in, we can still achieve the best outcome of it.
Yeah, exactly. You can definitely, getting the right type of assets, make your money work a lot harder for you than just, sitting in the bank.
Okay. Now, let's say when someone signs up with you, and we are basically getting into the main process that you have when someone signs up with you. Can you explain the whole process in in a overview detail, like when someone signs up on the day till the time they get the keys, like the settlement time, step by step?
Look, I guess firstly I'll divide my service, how it works, into two pillars. So pillar number one I have is lifetime coaching and community. Pillar number two is expert guidance. So that's the buyer's agency service side of things. Right. Now with the lifetime coaching and community, that's what I personally felt was missing in the market. It's why I try to give as much free value as possible via Instagram, and hoping to get on YouTube soon as well, just to give that, because I think it's very important for people to, even if they're working with an expert, have the tools and knowledge, equip themselves with that, so that they can also make sure the expert is not leading them down the wrong path. So with that side of things, all clients of mine get lifetime access to my private community, which is $350 now to access, where you get weekly live coaching calls, a comprehensive course with training videos in every single part of the buying process. And then they get access to all of my A-grade location research, lifetime access as well, which is $999 now. They get that included free in my service. And that basically lets them know exactly where and what we're buying, right now, and even 5 years from now, they'll see which new markets and what type of new assets we'll be targeting. So that's that coaching and community aspect. On top of that, of course, they get access to me directly. They can call me anytime,
Right.
WhatsApp me or any of my acquisition specialists with the expert guidance process. So firstly, when they come on board, they book an onboarding session that's going to be directly with me, where we sit down, have a chat, try to strategize, design their brief together if there's any personal preferences. I'll give my recommendations as well if I feel, sometimes people stand in their own way when they have a lot of unnecessary preferences, just so we can design a brief that we can really execute a really good deal on. From there, I take that brief, I do all the location research to figure out for their price point and other personal preferences, let's say the yield requirements, holding costs, things like that, where can we get the most value for money in the market right now so we can really maximize results for them in the coming years. I'll present that to them, we'll have a chat about it, make sure they're comfortable. Then from there, we'll start their property search. So with that, we're making hundreds, if not thousands, plus contacts a week to agents to source deals. We have a bit of a due diligence process. So like the initial process we have is the A-Grade Property Framework. That is basically all about minimizing risk and maximizing resale value. More importantly than that, I'll say, is pricing. We want to make sure we're getting the property at the right price, because sometimes there's going to be things on that framework that we have where we have to make minor trade-offs, but that's okay as long as the property still has good resale value and we're getting it at an incredible price. So that's the most important thing there. So all the sourcing is done for them, all the due diligence. We present properties to clients only when they pass our frameworks and they match their goals and their brief. So they only see the cream of the crop, which means that sometimes there might be a week or two where we have nothing to present. Because I'm not the type me and my team are not the type to just present deals for the sake of it. We want to make sure they're great deals. So once presented, if they're happy to proceed, we'll start the next steps, which are usually organizing inspections, make sure there's no red flags we can't see on the listing photos, and then negotiate and try to close the deal. If they're not happy to proceed, that's also fine. We're really big on feedback. Take that feedback on board so then we can refine their search moving forward. And then once we secure the deal, we just guide them all the way through to settlement. So connect them with all the relevant professionals, whether that's building and pest, conveyancing, property management. We coordinate all of that stuff with building and pest. We speak to our inspectors, understand the severity of certain issues, negotiate accordingly, and then just guide a smooth settlement. And then after settlement, I guess where a lot of people go wrong is they just forget about their property. They're like, oh, look, I've got a property now, celebrate, just forget about it. But what me and my team do is every 6 months, we're continuing to monitor that market to see what is their value of their property looking like and what is that market or that suburb looking like over the next 6 to 12 months. Does it look like it's going to continue growing in value rapidly, or does it look like it's going to slow down and the market, the growth cycle might come to an end? So then we can really plan the next steps accordingly. Is it worthwhile to keep holding this property, maybe wait for the next growth cycle, or offload that, consolidate debt, or reinvest elsewhere? So that's pretty much the full process. So you got that full buyer's agency service, but that lifetime coaching and education, all my location research. So it's kind of designed in a way where if you do have the time and confidence in the future, you can just try and do it yourself as well.
I think that's something I feel like professionals, the only thing they do is they don't give their secrets because people won't come back to them if the secret is out. But I feel like one important thing as well is when you're dealing with a professional, most people, the biggest mistake they do is they accept whatever they say. And you have overcome this by giving them the education, telling them what I am doing, how it makes sense. I think that's something very important for the people, and I think that's a very important trait to look in a professional when they're engaging their services, so that that tells the professional is really willing to help you instead of just making their own money. And I think this education component is a very crucial part of your service, I feel like, and that's something that people, I think your customers might be appreciating a lot, and getting the knowledge of the property market is very crucial. I think that's a really good thing. And but the whole process you mentioned, it's basically a long process. And what's a realistic time frame from engagement to the settlement, like for this whole process?
So usually within 48 hours of clients finishing their onboarding session with me, I come back to them with all my research and do all that stuff. Once we start the property search, that can vary. If they're not pre-approved, we have to wait for finance and stuff. But once we actually start, Generally, we take about 4 weeks on average to actually secure the right deal, get under contract. Sometimes we've got deals within 1 day, within 1 week. Sometimes it can take 8 to 10 weeks, depending on how difficult the brief is. For settlement, though, that can vary. Because once we get under contract, sometimes we have negotiated a 4-month settlement, 120-day settlement. Most commonly, we're seeing after getting under contract, 30 to 60 days after we settle on the property.
Right. And I think that's good. Overall, like what is the average period for the whole process, in terms of the number of days it takes? We're not talking about the settlement, but in which the main service that we're taking is finding the property and negotiating it, basically locking the deal. What is the average time frame? You said 4 weeks, in finding the property, but is there any maximum time frame you give to the clients that this is the maximum I will take to get you the product delivered?
Our focus is always continuing to work until we get the best outcome possible for clients. On my agreement form, I'll just put 3 or 4 months, just because we've never really gone above that time frame.
Okay.
But if we end that at the end of the agreement, as long as the client's happy to continue working with us, we just keep going. Not fussed about that. On top of that, we do give a 90-day money-back guarantee as well. So it's if we don't actually execute on the deal within 90 days of actually starting the property search, and clients don't want to continue working with me and my team, we just give a full refund. But otherwise, we'll just keep going.
That means if you're not able to give the product delivered in 90 days, your guarantee is you give the money back. And is it the same in customer side as well? If they don't want to, let's say you gave them so many properties during the period and they're like, we don't like it for whatever reason they have, do they get the money back as well, or they still have to be you have to continue with my service, I'll give you more properties that way?
Good question. Look, a lot of buyers agents they have a retainer fee, right, where there's a portion that they hold that is non-refundable. I think my agreement form says something like that as well, but I've broken that many times. I'm pretty flexible. I don't really care. Cool. If someone isn't happy with the service, I don't want their money.
Right.
But I've only had that once. I've actually told them I'll give them a refund.
Okay. Okay.
There's been a few other times I've given a refund where I didn't need to, but just because of personal circumstances, financial issues. One of the, one time it was a couple and the wife lost her job.
Right.
I don't want to keep your money.
Yeah.
You know what I mean? So I gave a full refund. But yeah, a lot of buyers agents, yes, they do keep retainer fees in some circumstances, but I'm pretty flexible.
Cool. I think that's good to know as well. I think that gives kind of a security to people, before engaging the services, because they don't know the professional in a full extent, what sort of things they're going to do. Because I feel like there are many professionals in the market who say so many things, and at the end they don't deliver the same thing they say. Yeah. So I feel like if someone is giving that kind of guarantee, like the 90-day guarantee, I think that's also a safeguard for them. If you are not able to deliver that product in that days, and they still have their money saved, and no issues, no disputes, and I think that's really nice. And I think now we have a good detail about how a buyer agent work and what is your whole process. Now let's get into a detail so that people, even if they don't engage a buyer agent services, they also know how to buy a property. Let's give people a detail so that if they don't have the money to engage a professional, they can still look at those things and the secrets that you have in order to buy a property. And I feel like let's start with the choosing a property, the location. Now, most Australians only buy where they live. That's what I understand, in terms of first-home buyers as well, and in terms of people who are investing for the first time. The common philosophy is buy where you live so that they can manage the property that way as well. So, but I feel like, as you said, you focus on the data and you buy where the data points. Now, what does interstate buying gives a client?
Look, I would say it's not even just interstate buying, but I would say what being unbiased when buying gives a client is really maximizing returns. Because look, right now, let's say if you do live in Melbourne, then it's maybe you should buy where you live.
I get it, yeah.
All right. But let's say when I started the business 3 years ago, I wasn't buying in Melbourne for myself or for my clients, because that's not where we could really maximize results. So I guess being completely unbiased, just following the fundamentals of what actually leads to maximizing capital growth, that's what's going to lead you to getting the best results.
The reason this question came is because I'm also looking to buy my property in the coming time, and the first thing when I'm talking to my family as well, because they also are like, how will you manage if you are buying interstate, or how will you manage those things? That was the reason I asked this question.
Yeah.
And I feel like many people might be like, even your customers who signs up with you, they are like, they want to buy at the same place, but overall the goal should be capital growth than actually buying where you live. And I think if ultimately, if property is giving you the wealth that you desired of, I think that completely makes a good scenario and a complete sense. Now let's talk about the location in detail. Like Australia has 6 states and 2 mainland territories. How do you choose which state to invest in general?
I don't actually go from the state level. I kind of skip that, especially because there are markets within markets. A lot of the time, states as a whole might not look very good, but there could be subsections of a market where there's incredible opportunity. So I guess I'd focus a little bit, I'll go one layer down and probably go into the council and the suburb level first, and how we identify, I guess, the best LGAs or councils and suburbs to be investing in is, firstly, we want to focus on risk minimization. How we do that is we want to make sure that council has a robust economy or a diversified economy. It's not just reliant on, let's say, mining or farming.
Right.
And it has long-term demand from people who actually want to live there. And I'd say decent population size. Like you could probably go to like a minimum of 20,000. Ideally, I wanted to keep 30 to 50,000 and above in terms of population size. So it's not a market that can be easily manipulated by some of these, large buyers agencies.
I understand.
But a market where people actually want to live long term, and it's the owner occupiers kind of driving up prices. So it's that sustainable growth. So that's how we minimize that risk. Now, to maximize capital growth, we want to make sure those councils and those suburbs are towards the bottom of the cycle. Mainly, how you do that is you want to firstly just eliminate all suburbs that have grown way too much in the last 3 to 5 years. Pretty much any suburbs that is like doubled in value or more than doubled in value over the last 4 or 5 years, you'd want to avoid that. You also want to keep it relative to the rest of the market. Like, who knows, we might end up being in a time where every single suburb across the country has doubled in value over 5 years. Then you just want to be targeting the suburbs that have grown the least, is what I'm trying to say, which sounds counterintuitive. A lot of people will think, oh, but shouldn't I be targeting the suburbs that have grown the most over the last 5 years? But that's not how cycles work. Now, if you find suburbs that haven't grown much at all over the last 5 years, 7 years or so, that's a great sign. But then you want to make sure that supply and demand has started to become imbalanced now. So now we know that lull period of 5 to 7 years has come to an end and it's starting its next growth phase. Right? So that supply and demand is that final, I guess, check. So just to summarize, I guess the 5 things that I mentioned, so diverse or robust economy, long-term owner-occupied demand, bottom of the cycle, and low supply, high demand.
So you mentioned, you summarized 5 points, but are there like more points than this? Like, is there any particular framework that you personally use when you are doing the suburb selection? I asked about the state selection. You said basically state does not matter. It's basically you go for the council, any place around Australia. So it's not like you're going for a particular, let's say Victoria in general. You don't take care of, you don't think about the state from starting. You go with the council, you think about all the factors you have mentioned. Now, apart from those 5 factors, like, do you have a big framework that you follow, or is it these are the only things you look at?
For sure. So like at the moment I have the A-Grade Suburb Framework, which I've created from my own mistakes, spending too much money on courses, and just refining it as I go, as I start to just analyze the markets deeper and deeper. So this A-Grade Suburb Framework at the moment has 15 points. I might refine this maybe a little bit shorter, or maybe add 1 or 2 things in here as time goes on. But yeah, there's 15 points in here. Like for the market timing, we definitely want to check like the last 3 and 5 years of growth, make sure it's not overperformed too much, and the last 10 years of growth as well. That's a little bit less important than the last 3 and 5, but that's in there too. In terms of supply, just to kind of simplify it, it's risk of future supply and current supply. So we look at stock on market percentage. That's a data factor that is very strongly tracked in the Australian property market that you can assess on different data platforms. So stock on market gives you an indication of the percentage of properties up for sale in comparison to the total amount of dwellings in the suburb. So you want to look at that, and you want to look at future supply. So you check for building approval. So there's data platforms where you can easily check for that too. Now from demand, just to simplify it, we want to make sure that if it's an investment property, especially, you want to make sure that demand is strong from buyers and from renters. So for renters, it's very easy. You want to check vacancy rates. Generally, make sure that's under 2.5%, 2% on average. You can be a little bit more flexible, especially if you're owner-occupier in an area. And then from demand from buyers, you want to check things like days on market, which indicates how quickly properties are selling. And you can assess, more importantly, with all these data factors I've mentioned, you want to assess the trends. You want to understand which way they're going. Is demand really picking up over the last 12, 18, 24 months? And we can see, okay, we're starting to see that imbalance form. The market's bottoming out, and we can start to see that next growth cycle occur. And then in terms of diverse economy, very easy to check, like the websites like Remplan. You can check all the different employment industries, the number of people employed in different sectors, and where the most amount of money comes from for that council. So if like a council's number one money-making employment industry is mining, generally you'd want to stay away from that.
I think that's actually a lot of information. And what we'll do is we'll put a summarize thing on the screen itself so that people can go to one point and then listen to your conversation so that they understand it better. Now, can you give me, like you mentioned so many factors. Now, can you give me a real example of a suburb and implement these factors into it, and so that people understand in a better way?
Let me think of a suburb. I'll tell you a suburb that I'm not buying in.
Yeah.
So let's say somewhere like Mickleham. I think that's Hume City Council, if I'm not mistaken, just like in the northern suburbs of Melbourne, in between like Craigieburn and Beveridge. Pretty much everything north of Craigieburn, you got your Mickleham, Calcallas, these type of suburbs. So let's say Mickleham, I can't remember the exact price point on average. I believe it's in the mid 6s or in the low 700s. The main issue with a suburb like this and a lot of parts of Melbourne, where, look, I'm very bullish on Melbourne over the next 5 to 10 years, but there's a lot of suburbs like Mickleham I'm not buying in, and mainly it's due to supply, because they got heaps of building approvals, so a lot of new cookie cutter homes coming up. On top of that, there's so much rental stock because you've had a lot of investors rushing into certain markets just because they can get depreciation benefits. They've been sold this idea from depreciation, all this stuff. And you're going to see more of that happen with these budget changes,
right,
where all these investors rush into just so they can get negative gearing. All of a sudden, they create these, what they call rental ghettos, where it's just full of rental properties. And because there's such a huge supply of rental properties, also you have a high supply of rentals, so vacancy rates are very high. So I believe vacancy rates above like 5 or 10% or something in a suburb like Mickleham, which is, to put into context, 5 times more than what we would look for a vacancy rate in a suburb. So another problem with a suburb like that has a lot of supply, even if it has a decent amount of demand, there's not much pressure for prices to grow. Because I like to put it this way to people: even if 1,000 people want to buy in a location, but they are increasing the supply by 1,000, then supply and demand is balanced. Right. So
I think that's a good way to explain. And I think let's talk about, out of all these factors, what are the, like, let's say two factors that do it yourself buyers almost never check, and what ignoring it costs someone in real money?
I think in today's market, more than ever, market timing is the most important thing.
Market timing, yeah.
Because, and what people don't pay too close attention to is the last 3 and 5 years growth. They don't check that, and you can check that for free on websites like onthehouse.com.au. You just click on suburb research, type in your suburb, and you can see the last 1, 5, and 10 years, how much a location has grown. And why market timing is so important is because in the last 5 years in Australia's property market, we've experienced a insane boom that doesn't happen every 5 years. Probably happens every 10, 15, 20 years or so. And that type of boom has led to a lot of locations across the country growing 150, even tripling in value over the last 6, 7 years or so. And what goes up that hard must come down or must slow down eventually.
Right.
So that's very, very important to check. You definitely want to avoid suburbs that have grown way too much. Another thing I guess we could say is, I think checking for a diverse economy. A lot of people, I think, are caught up with that idea of, I must buy a house or something like that, and they targeting all these tiny regional towns. There's no difference in capital growth between the right regional cities and a capital city.
Right.
And that's a complete myth, but targeting these tiny regional towns just because you can get a cheap house, but it doesn't have a diverse economy, maybe it's very reliant on like just one employment industry, that's a very good way to lose all your money.
Oh, I think that's also. I feel like we are getting so much crucial information today that people never even think of. Because whenever someone is buying a house, they are just like they googling out and they are looking at just few important factors and they are like they go for it. But I feel like there is a lot more to it, as you mentioned, so many factors to consider, and I feel like even if you miss, let's say, 50% of it, you lose a bunch of money. And it overall it'll affect your capital growth, your chance of making your life better after, let's say, 20-30 years of investing. And now, as you talk about, you already gave me an example of the suburb that is not good. Now let's talk about a suburb that looks amazing on the paper right now, but good yield, low vacancy, fair price, but you'll still not buy in.
Yep. I'll give an example of a suburb that I've bought in pretty much for myself and for clients as well. Let's say a place like Townsville, for example, where, let's say a suburb like Kelso. Kelso is southwest of Townsville CBD. We were snapping so many properties up there in the 300s, low 400s, already grown over 50 to 70% in the last 18, 24 months for a lot of properties we bought there. On paper, affordability is still relatively strong. Townsville is an excellent location, I'd say, even for the longer term. You got a lot of investments going into defense. You got a really strong healthcare industry there. I think healthcare is the leading employment industry as well, which is what I like to see, because healthcare is one of the most sustainable kind of economic drivers.
Right.
Because if we go through another pandemic, these healthcare workers are only going to make more money. They're going to get overtime, and they're going to be able to afford those houses. So that's why I like healthcare. So the economy is very, very strong in Townsville, very healthy economy, one of the best in the country, you could say. It's really transformed over the last 5 years. Supply and demand is still through the roof, especially because of affordability. So you got very low stock levels, low building approvals, vacancy rates are still very tight. Demand from owner-occupiers and from investors is still pretty strong. I know a lot of buyers agencies still buying in places like Townsville. But the main thing it's missing, and just like you said before, it's like if you check a lot of things, but you miss out maybe on even a little bit, you're going to shoot yourself in the foot a little bit. So supply, demand, long-term demand, and diversified economy, that's what it's got going for it. But what it's missing very strongly is market timing, because Kelso has already more than doubled in value in the last 4 years or last 5 years. And whenever I see a suburb that does that, a lot of people, they get this euphoria because they've made so much money and prices keep going up and people keep buying there, and people never think that there is a ceiling until they actually hit it, right? And when you see that much growth, you will hit a ceiling sooner rather than later.
I think that's where experience factor comes in. That's what I mentioned in the starting as well. People go through the factors, and a person who has not considered who even is doing the checklist, and they are like, okay, we are filling 12 factors out of 15. They may still lose if they are not. It's basically if all the factors are ticked in, I think that makes the best property decision. And if they are if they are not doing the whole checklist in a right way, they will lose a good amount of money. And I feel like the decision might even go completely wrong the way you said. Every factor, the major factors were going ticked in terms of Townsville. Yep. But one factor led to, like you are saying, you will never buy. I'm not saying never buy. You're not buying right now because of that factor. So I think that's a very good thing to know. That tells people if they're doing it themselves, they have to actually spend the time in analyzing each and everything and do it the right way, because if they are just taking information online and following it 50% or 60%, it's not going to help them to the best possible extent.
Yeah, 100%.
I think that's good to know. And now, in terms of suburb selection, like you mentioned about some websites, when you were mentioning some factors. Now, can you tell me, people who are doing it themselves, what tools they can use to find and validate suburb data?
So we'll start off, I guess, with the economy side of things. So there's free websites like remplan.com.au. That's where you can check out the employment industries, where the most amount of money is coming from for that specific council. You can also check council websites to understand any projects and what type of money is being pumped in for that council as well. And also, I'd say for understanding that long-term demand aspect, it's also good to speak to a lot of agents and property managers and stuff on the ground. Just understanding where is that demand coming from? Is it just a bunch of very large buyers agency companies who are pumping up the market, or is there a lot of demand from people who actually want to live in the location long term, which is going to create that sustainability. Now for data points, so I mentioned one free website like onthehouse.com.au where you can kind of assess market timing.
Right.
But I'm a big fan of triangulating data. So basically looking at multiple different data sources because there are some discrepancies with multiple and just kind of averaging out that data to get a real holistic picture. The best data is not free data, unfortunately. My favorite go-to website is DSR data. It costs, I think, about $180 a month. So like if you're doing it on your own, you'll only need it for a month. You shouldn't be doing a location selection for more than a month. So you only need it for that 1 month. Another platform you can check out is hashtag.com.au. So even with the free version of hashtag, you can see the data factors. You just can't see the trends, which are also important. But you can see the data factors. So if you just wanted to pay for one, like my go-to would be for DSR, but I do pay for multiple myself. I guess it makes sense for me because I'm running a business. But if you're doing it on your own, probably just DSR is the one paid one. Check out hashtag for free, On The House for free, and Remplan for free.
I think that's really crucial information as well, because I feel like no one tells you what softwares or what things a professional use themselves, so that people don't use it, and people are going to be like, if we can use it, why will we use a buyer agent? But I feel like here itself, the thing is, it's about, as you said, you are using multiple softwares or multiple websites or multiple data points to look at it. So definitely the expertise is going to give additional benefit on top of it when you are, because you know how to analyze the data. It's not just using things to take the information out. It's analyzing it in a right way as well. But I feel like as you mentioned, these websites or these tools will be simple to understand as well. Do you think so?
Yeah. Look, if you spend even just a couple of weeks just understanding the fundamentals and how to use the tools, very, very simple to use. But you made a good point there. It is very important to learn how to interpret the data. You should never see data as just a pure checklist, which is why I used to call my framework an A-Grade Suburb checklist, but now it's A-Grade Suburb Framework, which is not a checklist. Because a lot of people see, okay, the numbers should be like this and the numbers should be like that. You should never look at numbers on a screen and be scared by them. You should understand what those numbers actually mean. Like, what does it mean when days on market is this high? What does it mean when it's falling? Things like that. Because now that a lot of people are using data, to get ahead of these data-driven investors, you got to understand how to interpret it fully. And I have a good example off the top of my head where a lot of data-driven investors, let's say, were scared to invest in places in Bendigo, for example. We started buying there like late 2024. Late 2024. So very, very early, you could say. At that time, stock on market was quite high. So that was indicating a little bit higher than average levels of supply than we'd like. But what I started to notice was demand started increasing. Days on market started decreasing. And even speaking to agents and property managers on the ground, we could understand that a lot of demand has started picking up from owner-occupiers, some investors as well, and really strong rental demand just because of everything going on in the area. And I could tell it was starting its next growth cycle. And the thing was, when you understand what happens when demand increases, you know that supply will drop eventually because properties are getting sold quicker.
Yeah.
All right. So I wasn't scared of a little bit higher supply. I knew that's going to drop down very quickly. And as soon as that does drop down and the number looks nice, that's when all the other data-driven investors are going to start rushing in.
Right.
Right. So it's also about understanding trends and interpreting the data rather than this number should be this.
I think that's also good to tell to people because as you said, there's a difference between framework and a checklist, and that difference is the one that makes you a great investor to an average investor. And I think that's very good information to know as well. Now I feel like we know what all things are required to select a suburb. Now let's get into the next thing is basically finding the exact property. What all factors do you look at when you finalize a property in that particular area?
I think at the moment for my property framework, there's like 28 points. By the end of the year, I probably might add something in there or two. Or rather than points, I might add in some questions in there. Because there is a lot to consider on the property level. But just to summarize it before I get into specific points, it's all about minimizing risk and maximizing resale value. That's the framework that you have to come in when you're selecting a
Right.
property. Now, with a property, you can make a little bit more trade-offs. With a location, that's when you have to be really strict. Location selection is not as unforgiving as property selection. With property selection, the most important thing is actually pricing, because there's certain trade-offs you can make with properties as long as you get it at the right price. So, for example, there's things like noise levels and privacy. So, generally you would want to avoid main roads, highways. For privacy as well, you want to avoid those type of things. You want to assess for public housing to kind of minimize risk of bad tenants, or even if you're owner-occupier as well, ideally you wouldn't want to be living there. But there's things that you can make trade-offs. Like we've bought properties on busy roads before. And once again, it comes back to interpreting and understanding why you would want to avoid those things. So for busy roads, it's generally those type of properties can take a bit longer to sell, and they sell for about 10 to 15% less than the identical property in a more quiet location. So if you get it at the right price, and for that specific location and that busy road, if it doesn't affect the time it takes to sell, then you can maybe make that trade-off as long as the price is right. So like a property we snapped up recently on a little bit of a busier road, but it's in a regional location where a busy road isn't like that busy. And we checked the previous sales history for that property, and we noticed that it was selling very quickly every single time that it was on the market. So, we know the risk was minimal there for property. Let's say the buyer that we bought it for wants to sell in the future, you can still sell it fairly quickly. So yeah, it's still very important to interpret. Even public housing, a lot of people get scared about that, but depending on your risk tolerance, if you're okay with a little bit of public housing, sometimes maybe you can get a property for an excellent price, and the yield might even be better because the price is so low. But definitely things to consider. Transmission lines, very important thing to check for, because a lot of banks sometimes won't even lend to you, or they'll require you need a 20% or more of a deposit to buy a property that's within like 100 meters of a high transmission line, which a lot of people aren't aware of. Anything that can affect aesthetics in a major way as well, or like how long a property can take to sell. Things like cell towers. Let's say you've got a massive cell tower right behind the property, that can definitely be a bit of an eyesore and affect resale. Transformer boxes being like right in front of the property, that's something to kind of be aware of as well. A lot of people get scared of them for safety reasons and for aesthetics. What else? Flood and bushfire risk is very important. Like we're talking about Townsville, that's one that we had to really assess the flood risk. And this is also where you go a little bit deeper, because like in places in Townsville, when you check the flood maps, there's places where there's like 10 centimeter flooding, basically. So those are like very, very minimal risk. Insurance costs are very low for those properties. You can maybe make that trade-off there. For bushfire, for example, like I think we were speaking about Bendigo. Bendigo, half of the city is in a bushfire zone. All right?
Oh, okay.
And matter of fact, half of Australia is in a bushfire zone. The train lines you mentioned as well. So that's important to consider, but then also important to put it into context, because a Melbourne Metro train line where you got 30 to 40 trains running along, that's very different to, let's say, a regional train line that only has 3 or 4 trains passing by every day, right? So important to kind of make that distinction, understand. It's important to understand every factor and why it might be a detractor, and how it can affect sale price. So then you can know when to make the trade-off as well. So that's very important to understand. What else? Heritage overlays is important, especially if you're looking to do any major renovations or development. So if you're looking to do any of that, definitely need to assess that. And even if you're looking to do development, checking for easements as well, because you generally can't build over the top of them. So you need to understand where they are at and if the development is still feasible. Some of the main ones, I think. Anyone missing?
No, I think that's actually, you said 28 factors, so that's going to be a big list for sure. And I don't expect you to remember all 28. But I think if you can give me, I think we have covered a good amount of them, and we'll definitely put all those 28 factors for the audience to look at. And I think that will give them a good insight about how it works. And out of these 28, can you give me 5 killers, and for each a real property you have rejected because of it?
Okay, I'll say public housing is a big one. Someone like myself, I have a little bit more risk tolerance, but for clients generally we do avoid public housing percentage. So like there's websites like openstats.com.au that's completely free, and we have some paid softwares that we use as well. But just for the audience there, like there's free softwares like OpenStats, which is awesome. You can check put in an address, you can see the owner-occupier percentage of that pocket of that suburb where the property is. So you can understand what is that pocket like? What is it? Majority owner-occupier driven, investor driven, and how much percentage of public housing is in there. So there's a lot of places like, for example, Geelong is a great location to be buying in right now, and Corio and Nor Lane is definitely one of some of people's favorite suburbs just because of the affordability. Corio has pockets of the suburb that have over 60% public housing in that pocket. Basically means that 6 out of 10 people living there are public housing residents. A little bit of a rougher part of town, right? So especially for investors who kind of want to really minimize risk, or owner-occupiers who want a more family-friendly location, might not be suitable. So public housing is a big one. Bushfires, not actually that much of a big one. I'd say flood though. So we'll do flood number 2. I think flood risk is very important to assess. There's a lot of areas in Queensland especially where they're prone to major flooding. Places in Victoria as well, some of them are prone to it as well. Shepparton is a good one. A lot of people don't know, but like 30 to 40% of the town goes underwater when it floods, right? So
okay.
Very important to understand the flood zone.
Did you ever buy a property in Shepparton for your clients?
Haven't for clients, actually.
Okay.
We've looked there for clients, but we generally look at multiple regions at once for clients and go wherever we find the best deals. And we've just always ended up finding a better deal somewhere else for some reason.
Got it. Yeah.
But it is a place that I did used to look quite a lot. I'd say transmission lines is important to be at least 100 meters away, especially from a lending perspective.
Right.
If some people maybe only have a 10% deposit to put down and they buy a property, and then all of a sudden the bank says, no, we need a 20% deposit, it'll be a bit of a headache. You could just back out of the contract using a finance clause if you have that, but I'd say that'd be a big one. I'd say, I guess it depends on price, but being on especially in a metro location, being right on a highway or very main busy road, I'd say generally you'd want to avoid that, especially if you want to maintain liquidity in the asset, meaning in the future, if you want to be able to sell it quickly, it's probably something you'd want to avoid.
I think that's one of the major goal of everyone around, like apart from the first home, definitely people, the goal is to get the maximum benefit, the maximum capital growth, make good amount of wealth from the property. So definitely that's a major goal, and definitely that factor has to be considered to do this. Now another thing is, after we select a property, while selecting a property, I'll say, one thing that I know about is off-market properties, and by off-market properties, like many people don't even know what off-market property is. So can you please explain them what exactly that means? And let's start with the basics, and then we'll get into it. Yeah.
Awesome. I love talking about off-market properties because it's such a marketing buzzword in the industry these days. But for people who don't know what off-market properties are, they're just simply properties that are not advertised on your major Australian real estate portals, which is generally realestate.com.au and domain.com.au. So they're just properties that are not on there. That's all it is. Nothing special or magical about them.
So it's basically properties that are directly reached by a real estate agent, a buyer's agent, or someone like, let's say my friend is selling a property and I bought it from him. That's basically off-market property. That's never advertised online, and I had access to it because I knew that person, or the whatever way I could have access to it. And I feel like when we talk about buyer's agent, one of the major reasons, when I talk to other people as well, and one of the major reasons people go to buyer's agent is because they have access to so many off-market properties that people normally they won't have access to. So do you also use most of the off-market properties when you're giving it to your clients, or like it's what sort of mix is it?
I'm pretty sure we're over 60-65% of properties we've purchased now for clients are off-market.
Oh, okay.
So majority has been off-market, you could say, but our main priority is always getting the right deal at the right price. Some of the best properties I've ever bought have been on market. Like just recently this week, Farhan, the acquisition specialist who works alongside me, he's bought multiple properties below the highest offer just because of the unique situation going on with those specific deals and acting quickly. So it's not just to go back to the topic, we can go on a tangent later on, but so it's not just that off markets are best deals, it's just they do give a competitive advantage purely because you can see more properties. That's the main competitive advantage that
Right.
they can give. But out of all the properties you see, it's about getting the best property at the best price.
I understand.
That could be on market or off market.
Now, definitely, you are an expert, and buyer's agent or real estate agent, they do have access to all these properties. How can a person like me, who is not an expert in property and who only knows if I want to buy a property, I'll just go to real estate or I'll just search it online.
Yep.
How can they have that access to the properties? How that network can be built so that they can also do the same things themselves?
For sure. There's quite a few ways. I'll tell you the main way or the easiest way is to just build relationships with agents. Two ways you do that is through calls or emails. Calls is always the most preferred way. That's how you can build the most amount of rapport. A lot of people just spam agents with emails and texts and stuff, and they get tired of that. So calling them, trying to build some rapport with them. You need to be able to come across as a serious buyer. Maybe you can let them know, look, I'm pre-approved. I'm looking at I'm looking for a property in this council or this area in the low 700s. These are maybe kind of some of my personal preferences. Do you have anything coming up? But also find ways in your conversations to also not just sound so transactional. Maybe you can do a very brief amount of research, and when you're calling an agent, say first thing you could say is something like, I loved XYZ street that you sold last week. That was a fantastic property.
Right.
Do you have anything similar like that coming up soon? That's a great way to just start a conversation. A lot of people just pick up the phone and say, hey, you got any off markets?
I think it's basically praising the person first and then getting what you want.
Yeah, you say that. You could just say something random just to break the pattern
I
that
get
they
it.
used
Yeah,
to.
yeah, cool. I think that makes sense as well. And as we are talking about off market, but let's first get into this. Before, apart from reaching out real estate agents, is there any other way, or that's the only way out? Building relationship with them.
There's other ways too. That's the easiest way, just because agents are constantly going door knocking and all that stuff to get listings, right? But you could do the exact same thing as what real estate agents do, right? So you could be door knocking if you have the confidence to do that. A lot of people do letterbox drops. That's very very popular in the property flipping community, because letterbox drops are a good way to find properties that are quite run down, where even maybe some sales agents don't want to sell advertise them because they're not nice looking properties. So a good way to get some value add kind of properties there, letterbox drops.
I think letterbox drops are definitely better in terms of if I'm going knocking someone's door and I'm not a estate agent, it look definitely weird. Like, are you willing to sell the property? But I feel like that's basically a safer alternative to do it. Like just dropping the letters, and if they want to do it, they'll definitely reach you out.
Yeah, 100%. And another interesting way is. Interesting way that I've got off markets directly from sellers is sometimes on Real Estate and Domain, you'll see properties listed for sale and it says for sale by owner. And that's a website that a lot of people who want to sell their property, they use if they don't want to use a sales agent, right? And so you can go direct to the seller. And I remember I've bought a few deals. I remember in Townsville when I was buying a lot there from for sale by owner. And I made the transaction so smooth for them that they told all their friends about me. So all their neighbors in Townsville started directly contacting me. So I had off market directly just from the seller.
Cool. So basically, it's more of a referral thing as well. So if you instead of being a buyer's agent, people were starting selling you the properties as well. So that's a good thing to know. And basically, how many calls a week? Let's say you said you do a lot of calls to get access to that 60% properties now. And how many calls do you do a week? And how long does it take before it produces an actual deal?
Look, I've personally slowed down on those calls now, just because I'm focusing more on strategizing for clients coming on board and getting more clients on board. But I genuinely recommend my acquisition specialists to make a minimum of 20 calls a day. So let's say 100 a week, very, very manageable. You could smash out 20 calls within 1 hour, 1.5 hours max. You know what I mean?
Cool.
So yeah, generally that much. The more the better.
I get it, yeah.
And when you're targeting a specific council, it might be worthwhile to create a list of all these agents. And the first time you're going through that list, it might take a long time, because let's say there's 100 agents there. But then let's say the next week or two you're calling, you've narrowed it down to maybe 30 or 20 agents that are worthwhile calling, because a lot of them might not even be worthwhile calling.
I think it's all about filtering it down to few. Definitely when you're starting with something, even cold calling, when you're selling things up, it's basically reaching out to so many people, and then you come to a funnel, where these are the good people in the market, and you can reach out to them for future. And once you build a relationship with them, definitely your future purchases will be easy as well.
Yep.
Yeah,
100%.
I think, and also with off market, one thing I feel like people assume, and even I assumed as well, that off market means a better price. Is it the case, or?
Most of the time these days, it's actually not the case.
Okay.
We reject probably more than 95% of off markets that we get. Especially, look, when it comes through an agent, at the end of the day, like we discussed at the start, is agent always wants the best outcome for the seller. Like this morning on my live session in my private community, someone shared off market for me that they got from an agent in Geelong for $610,000. This was in Corio. It was like, I think 3 or 4 times the price than what it sold for like 10 years ago. They have done a little bit of work to the property, but it was just so overpriced, and even that person knew it, which is why she just wanted to confirm with me. So a lot of agents, what they'll do is they'll try and sell a property for way above market value, what they know that it'll get on the market, and they'll try to do that off market because they know a lot of people get excited by off market properties, and they'll just pay whatever and try to close a deal. So you still have to do the exact same due diligence, run your numbers, do the valuation, make sure the numbers actually stack up off market or on market.
Makes sense. I think now we know about buying the property part as well. Now let's go to the valuation part. Once a property is finalized, how do you actually value the property? Because there are few indicators. What I personally understand is when we search about a property on real estate, they do give a brief. Is it the right valuation? Like should people just go for that valuation, or are there you use a entirely different way to do it?
Yeah, generally it's not. So you want to ignore. 2 main things you want to ignore is these automated valuations you'll see on realestateordomain.com and the listing price, because none of those things generally indicate true market value. Listing prices just can be a marketing tactic. The automated valuations you're referring to, this is just a computer algorithm trying to make sense of what's been happening and try to give a number. And a lot of these times, this valuation can also depend on the previous sale price. So let's say a property sold for a very, very low price 10 years ago, and they're just assuming, look, the suburb has grown this much, so I'm going to estimate the property's this much. But maybe the property's had a full bathroom, kitchen, reno, and they've been replacing the carpets with some premium flooring. It could be a completely different property now.
So many different factors.
So the main way you want to evaluate is looking at comparable sales. So properties that are similar, some properties that might be a little bit inferior to the property you want to buy, and some properties that might be a little bit superior to the property that you want to buy. So you can get an idea of what price the property you want to buy is at. And ideally, you want those comparable sales to be as close to the subject property as possible. Because sometimes, let's say, or in a similar type of pocket, let's say you're looking to buy a property in a premium pocket, you don't want it to be compared to a property that might be similar in terms of condition, but it might be in a public housing pocket. So that's why it's sold for cheaper, right? So kind of similar everything, similar style of pocket, condition, land size, all that type of stuff. So you can understand what is the true market value. But on top of that, you have to also understand, if it's a fast-moving market, how much has the suburb grown since those properties have sold? Because let's say you're looking at some comparable sales. Let's say you looked at one at $650K, but the market has grown $30,000 since that property is sold. We've got to factor that in.
Right. I think that's a good way to know. Are there any tools people can use to do the comparable sales?
Yes, you just go on Real Estate or Domain, mainly for free tools. Go into the sold section and put in the property specs, and you can see all the recent sales.
Cool. That's good to know. And now we know the true value of the property. Let's go to the most terrifying part, that is basically negotiating a deal with the seller. How do you do it?
How do you do it? So I guess to simplify, there's two things you need to focus on with negotiation. There's price and there's terms. So pricing, obviously, look, depending on the situation, sometimes you might be able to get a lower price if the terms are very favorable for a seller. So that's one of the ways we got a property below the highest offer multiple times, because we've given terms to the seller that they require. Sometimes, let's say it's an owner-occupier who needs time to find another family home to move out to, so maybe they need a rent back. So we put a special condition saying, look, we're happy to rent the property back to you after settlement, so you can take your time to find another house. And we've got properties, $10,000 below the highest offer because they didn't offer that terms, right? So terms are very important. The main terms are finance clause and building and pest clause. Generally, if you can find a way to shorten these as much as possible, or even remove them somehow, without adding any additional risk to you, that makes the offer very strong. And then, of course, pricing. In a hot market, if you're competing with 10 other people, generally we'll have to pay a fair market price to secure the deal.
Cool. And what's the biggest discount you have got for your client?
Biggest discount I've gotten for my client. It depends how you define that, right? Like in terms of discount, if you're defining that, I guess, based on comparable sales, there's been many times. Just recently, we got a property in Pakenham, that's in southeast Melbourne, 700 square meter plus block. We got that for $550,000. Pretty much got land and got a free house on top with that deal. Even real estate had it at 650K, and comparable sales were at like 650, 670K as well. So you could say, quote unquote, 100K under market, but I don't like using that term.
I think 100K is definitely a number that that basically attracts people as well. Now, apart from attraction, it's basically, getting the true value and negotiating it with the people. Because if someone like me is directly negotiating it with an expert, definitely they'll not be able to negotiate in that particular way because they don't know the factors. But I feel like based on what we have told the viewers right now, they can use all those factors and they can use those tactics to talk to the agents and tell them what basically they know everything, what's wrong in the property, and they can negotiate it that way as well. I think that's all good. Now let's make things a bit more real. I'll give you 3 scenarios and basically 3 buyers, 3 budgets, 3 goals for each suburb property type. You just have to give me due diligence of a strategy and where they're in 5 years.
Yep.
Okay, so starting with the first scenario, first time investor, 700K, Melbourne, wants growth, not cash flow. Which suburb, what property, 5-year picture?
For sure. If they can afford the holding costs, I would probably stick to a freestanding house above 400 squares or even above 500 squares in southeast Melbourne. Like we recently just got one at 697K. Established pocket of southeast Melbourne, 500 square meter plus block with a 4% yield.
And let's talk about established investor, $1 million budget. Which market and 5-year outlook?
That also depends on their holding costs. So if they can comfortably afford a $1 million property, which is probably going to have like a 3.5% yield, or they have the cash to do a value add where maybe we can get something at $950K or $1 million, spend 100K in renos and lift up that yield as well as increase equity. That'd be the way to go. Otherwise, if they need a bit more of a balance of growth and cash flow, would probably stick to a 650K property, maybe in regional Victoria, freestanding house, 4.5% yield and above, and then maybe a 350K undervalued blue chip Melbourne unit.
And now let's talk about an established investor with $2 million budget. Do you look at just one property or you give them a combination of properties?
It depends on that individual, how comfortable they would be with the holding costs for that $2 million asset, because they can be fantastic opportunity, especially for value add plays in these very old established suburbs in Melbourne right now that are towards the bottom of the cycle. Where you can snap up these deals, let's say 1.8 to 2 mil, spend a couple $100K on renos, and you could probably increase the value of that property by more than a couple $100,000 as well.
Right.
You put in $1, you can probably get back like $3. So that could be the way to go if they can afford the holding costs. Otherwise, would probably try and divide that up by about 3 properties, you could say, around that 650, 700K mark.
Right. I think that was a good explanation. Different scenarios. I think people who lie in that category, they have good information now, what needs to be done. And now just we'll also talk briefly about this thing, the types of properties, apartment units and townhouses, residential. Now, if you can just tell me what offers the highest capital growth by order, by ranking, like, yeah.
For sure. Look, I'd say houses, when you're prioritizing land where land is scarce, that's very important. Don't just buy a big block of land in the middle of nowhere, but generally houses over the longer term will generally have a bit more capital growth than other types of assets. I'd say townhouses and villa-style units are pretty much on par in the right locations, maybe a little bit less than houses. And I'd say your 3 to 5 story kind of boutique unit / apartment blocks, a little bit under that, but the yield is so high that it can make up for that less capital growth. But you can still get above average capital growth with all assets. But it'd just generally be houses, townhouses, units, and apartments.
I get it. But with apartments, the common scenario is people are like, don't buy apartments because they don't offer capital growth. Is it true or?
Yeah, if you buy a high-rise apartment in Docklands, 20 stories plus, then yeah, definitely avoid that. But if you're talking about boutique blocks, 5 stories and under, even ideally 3 stories and under, and you're buying it at below replacement cost. So if you can buy a unit for 350K, but it costs 500K to build, that's where the scarcity component comes in for units, and that's where a lot of value is to be had. Now, people with that same mentality, they missed out on probably buying units in the Gold Coast for $300,000 5 years ago that are now $700,000-$800,000.
As we both are Melbourne based, let's give Melbourne people top 5 suburbs with the price caps that is on your top list.
For sure. Look, I'll start with the higher budget ones, and then we'll go to lower value ones maybe. One expensive one I can say is probably Yarraville. I'd say that is like a very undervalued blue chip suburb at the moment. Pretty much right next to the CBD, landlocked. You can get a freestanding house sub 1.5 mil. Go to a similar place in pretty much any other capital city around the country, especially in Sydney, you're looking at upwards of 4 mil probably for that same kind of house on a decent block size. Some for more affordable price ranges around the 800K mark, I would say a suburb like Narre Warren, super undervalued. You got just pure long-term owner-occupied demand in that kind of suburb. A lot of neighbouring suburbs in the southeast are looking good. I guess just to quickly answer, you got suburbs like Berwick, Hampton Park. I'd say a lot of those suburbs are very undervalued. If we go up to the north, we could say suburbs like Meadow Heights. If we go maybe to the northwest, we can say suburbs like Deer Park. Makes up 5.
Cool. Yeah. All good. We wanted to give more, but I feel like definitely you can reach out on Allan's Friday Q&As, and he answers all the questions there as well. So any suburb you have in your mind, just drop a question, and I feel like Allan will answer in a better detail.
For sure.
And now I'll say let's wind up the whole podcast. We have provided a good masterclass style information for people who want to buy a property. And now this is a big decision movement. This is a question that I ask all the guests on my show. Tell me about the biggest decision you have made in your life and what it taught you.
Oh, such a tough question. The biggest decision I've made in my life is to, once I've decided what I want in life, do so much work that it would be unreasonable for me to fail. And I'll mention a couple, I guess, decisions that are connected to that as well.
Yeah.
Once I've made that decision now, so like let's say it's like starting a business or becoming a successful property investor, it's also the decision you have to make after that is not being so attached to the outcome, but also learning to love the work and the journey of the person you're becoming along the way. Because once you do so much work, you start to realize the work does work on you. So it's more about the person you're becoming and enjoying that process along the way.
I think that's a remarkable story. Thank you for your time, Allan. Now, I feel like the people who build wealth aren't the smartest. I think they are the ones who got educated, then acted. Everything I feel like Allan mentioned today, shared only matters if you act on it. A checklist are on the show notes. Pick one thing and do this 1 week. This was Big Decisions. I'm Karan Bahari signing off.